What's up, everybody? Eric here, and I am super excited. I've got a special guest today, Ivana. She's the founder of Spear Invest. How you doing today, Ivana?
Doing great, Eric. Thanks for having me on.
Absolutely. I've been looking forward to this for a long time. What's awesome about Spear is you guys invest in secular growth trends and mega trends, disruptive technology, and a lot of what we do at Fired Up Wealth is we invest in those growth trends as well. So there's a lot of overlap. So this is really a video focused on the best stocks to buy, really with an AI, but also data center. All right, Ivana, so this is the artificial intelligence value chain. Now you put this together. Walk us through it.
So, Eric, as you can see here at the bottom of the value chain, you have the hardware providers. And this ranges from processors to networking to even some tangential areas that we can go into deeper later in the video. But basically, the hardware layer is the foundational layer that everything is built on top of. And then you have the data infrastructure layer. This is the one that is a little bit more complex because you have all kinds of different business models from the data infrastructure providers like Snowflake, like Databricks, to model providers, which are a completely different model, right, in terms of investing in businesses. So there is a very broad range, and cybersecurity companies are here that offer services on top of the data infrastructure. So a lot of different businesses with different fundamentals. And then on top, you have the application layer. This is where we're focused on a lot this year because this is a newer and more emerging area, and we're going to find a lot more opportunities as we go forward. So companies are just introducing these co-pilots and they're just starting to charge for them. It hasn't really been reflected in their fundamentals. Similar for companies like Tesla, they're just coming up with FSD and robotaxis. So these companies will look very expensive on fundamentals basis because they haven't really produced any earnings yet from this AI trend. But as we look forward, we're going to see a lot of upside here. So a lot of opportunities across the value chain. I think it's very important for people to understand each individual business that they're invested in because each one of these has a very different risk reward and value proposition.
Yeah, that's really good. One thing that if you follow the channel here, we've been talking a lot about phase one infrastructure for Gen AI. So back in 2023, we did a top 10 AI stocks to buy for the next decade. And we've been talking about phase one and phase two. It's very similar to the layers you have here. So the hardware, phase one infrastructure, we're talking about the Nvidias, the Broadcoms, the MRVLs, the Arista networks. Of course, when you think of the semiconductor value chain, Taiwan Semiconductor is going to be the foundry that produces most of these advanced chips in the world, right? 90% of the advanced chips coming out of Taiwan. And then you've got the data infrastructure. And what's really interesting about companies like Snowflake, and I know you have a decent sized position of Snowflake, and so do I. And I get questions all the time, like, why are you still bullish on Snowflake? That stock's been a laggard. Well, might have been early in the stock, but I do believe that companies like Snowflake, of course, we know that Palantir has been on a tear. Retail especially is very much on board with Palantir and even institutions jumping in on that. With Snowflake, what's really interesting about it is looking at some of the data. When you think of inference and the cost, that's going to be a huge part when you think of AI applications in the future. And there's some stats that came out last week about 75% savings when you think of Meta Llama. And I really do think that Snowflake can help a lot with things like inference. Do you share the same view on that, or what are your thoughts just on Snowflake?
So 100%, Eric. So I think where Snowflake is in the value chain is basically connecting companies to these models. Yes. So all of these announcements like DeepSeek or Llama, any basically advancement on the model side that reduces the cost of using models is a pretty significant positive for Snowflake because it basically broadens the amount of customers that can build and can use the hardware basically associated with this model. So I think really like a lot of people freaked out and sold everything through like across the entire value chain post the announcement of DeepSeek. But I think it's going to be a big positive for many of these companies. Not so much on the model side. I think closed source models are really going to come under attack, but anything on the more open source side or on the infrastructure side and even the hardware side, I think it's going to be a pretty big positive.
Yeah, absolutely. So another way to look at this is simplify it for the audience. The hardware here is going to be that infrastructure phase we talk about. That's really building the LLMs, right? So you're talking about the hardware, the GPUs, the data centers that are going to essentially help build and train these models. what a company like Snowflake does then is take that built model, right? And there's tons of different ones. Those are becoming a commodity, right? There's tons of different large language models, LLMs. Taking those different LLMs and connecting it to enterprise data. So your proprietary enterprise data, being able to take that data, to manage that data efficiently, effectively. We would talk about garbage in, garbage out. It's got to be clean data. The data's got to be structured the way you want it. But taking that company data, the enterprise data, and then connecting it to those large language models, which you alluded to, but to put that into more detail for the audience, correct?
Yep, 100%. That is exactly how it works.
Yeah. So when you think of these different layers here, you've got cybersecurity and observability, and these are some of the same stocks that we've been bullish on for years. Actually own all these stocks except for Palo Alto Networks. You think of SentinelOne, more focused on SMB, CrowdStrike much more on the larger enterprise. Talk a little bit about this layer, because there's, Datadog, Zscaler, CrowdStrike, Microsoft. These are some fire to ball favorites, and we've been recommending Palo Alto as a top cybersecurity stock, even though I don't actually own the individual stock. Talk a little bit about this layer for us, if you don't mind.
Yeah, for sure. So we see a lot of opportunity for cybersecurity. Obviously, everybody knows that cybersecurity demand is very strong. But as we get further into the cycle, I think you're going to see the cybersecurity companies also introduce AI-based products. And this is what we're really bullish about. So companies like CrowdStrike, they already have Charlotte AI. This Charlotte AI is going to really take a whole new, go to a whole new level with the advancement in language models, right? Similarly, Zscaler has a product, Datadog has a product. So this is what some people refer to as agentic AI. So they're going to be little cybersecurity agents that you can use on your desktop to tell you and help you manage your cybersecurity vulnerabilities. So I think this is going to be really powerful. We're really in the very early innings of it because first, there are very few customers that use it. It's been scaling, right? It's been now a year. But then also, I think the usefulness of these is going to really step up as technology improves. So I think you really are going to have to be patient with this layer because you're not going to see a similar bump in earnings as you see in hardware, where you like immediately sell more hardware and your revenue jumps like 40 to over 100%. Right. Here, it's going to be a slower adoption curve, but it's a very solid business model because it's all subscription based. So a lot of the metrics where we are focused on here are the net new ARR or current billings or any sort of like current metric rather than top line revenue. I think a lot of people are focusing on the different metrics here. And this is why these companies haven't performed all that well over the past year. I think it's just this focus on revenues versus like what's happening today.
Very well said. And just for the audience that don't know, we're talking about software as a service, recurring models, revenue models, right? So this is SaaS, software as a service. Now, when you think of Snowflake and MongoDB, those are going to be pay-as-you-go, consumption-based. So different models there. It's important to understand that. Palantir is going to be more of that SaaS, but she's got it in the data platforms because it obviously fits better there than the cybersecurity observability. But one thing you hear me talk about all the time is I like models that have those recurring revenue models. It's very difficult when you have things like advertising models where it's very cyclical. There's ups and downs, there's peaks and valleys. As someone who worked in software and sold software, the nice thing about it from the business side, not so much as the sales side, because the sales side, they expect you to, sell more every quarter. But when you think of it from the business operations side of it, what's really nice about it is you have that stability. There's less peaks and valleys. In other words, that revenue is recurring. You don't have to go out every single quarter and start from zero. And that's, a lot of the companies that you think of that are advertising focused, even like a Meta, Google, Alphabet, Google, a lot of it is, digital advertising. I still like those companies, but I really do favor the subscription recurring revenue models. And that's what this basket is, or this layer here, to explain that layer a little bit better, I guess. Does that make sense?
Yeah, and Eric, that's particularly important if you're investing through the cycle, right? Yeah. So you may have 1, 2, 3 years, especially when you come out of the downturn, where these companies don't keep up maybe with the performance of the more cyclical ones, but over the cycle, you're going to see a much better return on investment.
Okay, so this is the AI data center value chain. and it allows us to have a glimpse into the hardware layer a little bit better. I specifically want to talk to you about a couple things today. One being the energy side of it. It's just an area that I have not spent a lot of time researching on. So we're very aligned with the majority of the stocks that we like within AI in these sectors. But energy is a space that I've never really invested a whole lot in. I've kind of avoided it. I'm a big Munger guy, circle of competence, invest in what you know, and energy is just not an area I know very well. So I think that'll be really helpful for our community to hear your thoughts on that, because I know you have some of these stocks, and we'll show you the stocks that you have within your ETF here soon, SPRX. But break this down for us. Explain what's going on this.
So Eric, I've spent a lot of time on the energy side. So I agree with you spot on really spending time where you have competence. And I think that is really important. Here on the energy side, there are a lot of different business models and different things you can invest in. One of the areas that we really like is the power generation side. And the reason why is because we have gone through a very significant downturn in power generation in the US. So what we've had is a lot of renewable capacity get added to the system at the expense of baseload capacity. So while that's great for the environment, the system has become a lot less reliable, and that basically needs to be fixed right now. So there's a lot of demand for nuclear. Nuclear is really positioned very well to fill the hole because it's both green and reliable. There is also a lot of demand for gas. Gas is a little more controversial from environmental standpoint, but companies are talking about clean gas and carbon sequestration. So really, it's going to come down to nuclear and gas capacity that's going to fill the gap in terms of demand. And I think what's very important for your viewers to understand is that while data center is the big driver that everybody is excited about, even without data center, just by the market growth and the economy doing better, there is going to be pretty solid growth in energy demand. So for us, this is a way to be slightly more diversified than just be invested in processors and networking, which follow very similar fundamental dynamics. The energy side, while it's tied to the broader theme, follows very different dynamics. So what you're going to see, like when the market freaks out and the weekends get shaken out, everything sells off. But then over time, energy investors or power gen investors will come to the names that have fundamental support. So we really like this, both because we see a lot of upside, but also as a way to get exposure to another area that's tied to data center spending, but not as directly to the chips side.
And which stocks specifically do you own in your ETF that are in this power generation?
So Constellation Energy and Vistra are the two that we really like. And energy, we have a smaller position in. Constellation is a leader in nuclear. They operate the largest portfolio of nuclear assets in the US. And then Vistra is really more a play on gas. They also have some nuclear generation, but they really have an underutilized gas portfolio. So usually the companies that have these marginal plants, once those become in the money, you see a lot of upside. So I would say from a risk reward perspective, Constellation is lower risk. Vistra is a little higher risk. And then we expect the return to be commensurate with the risk we're taking. So from risk reward, they both look pretty attractive. And then on the equipment side, we're finding a lot of opportunities as well. And we like GE Vernova is one where they provide the gas turbines, and lead times right now, if you want to get a new gas turbine, extend 2+ years out. So you have really pretty good visibility here from demand perspective and from pricing for this company. So I think it's a nice way to kind of add a little bit of diversification to your portfolio while still sticking with the broader AI theme.
So that's perfect. Now I'd like to just have the one-on-one conversation here, get the screenshot
without the images. Yep.
Yeah. So can you explain to me, so one of our community members, Easy, he was explaining that with these power companies, these private companies, they have auctions, right? And so they can basically get a lot more. They can charge a lot more than something that's government regulated. Can you talk a little bit about that? And do these companies that you invested in fit into that category?
Yep. So basically, the way to describe the landscape is that you have regulated utilities and IPPs. So regulated utilities would be the likes of Dominion Power. These will be companies that don't necessarily see the immediate benefit from prices because they need to pass through prices through the regulatory process. So anytime they want to raise prices, there is a process that gets involved. So they don't get the benefit immediate from price increases. IPPs or independent power producers like Vistra, like Constellation, they basically get spot pricing. There is some contracts as well, but it's really dependent on the market dynamics rather than ratepayers. So this is the area, like if you wanna take very low risk, the utilities look attractive as well because as power prices go up, everybody will benefit. But it's the IPPs will benefit a lot more because they are exposed to like spot market dynamics.
So what do you say to somebody though? It's like, yeah, that's great, but these stocks are up 100%, 200%, 300% a year. Are they still attractive? Is there still enough demand in the future? Like, can you talk through that a little bit?
So I think the price appreciation is not necessarily a valuation factor. So a lot of times people will say like, hey, this is up 200%. That means it's expensive. That's not really how it works. So it really all depends on what earnings they're generating and what multiple are you willing to assign to those earnings. And what's been happening in the past year and a half is those earnings are really going up. And it's not just the current earnings, like, for example, companies like Nvidia, where you're seeing like current earnings upside. Here you have a visibility 2+ years out in terms of what contracts are signed today, in terms of where the pricing is going later. So if you model out 2 to 3 years of pricing, and this is not like you're putting in price increases, this is already prices that are in the market today, there is a pretty decent earnings growth. And on top of that, multiples have expanded, but not nearly as much to compensate for the higher earnings growth. So I think the business models also have really transitioned from the past where it was really much more driven by what fuel sets the price. So earnings were a lot more volatile. So if gas sets the price and then gas price moves, then earnings are going to be all over the place. When it's demand driven, like we're seeing today, you're going to see the prices being a lot more stable. So because the upside is demand driven, I think we don't expect as much volatility like in 08, 09 when gas prices collapsed. And that was really the driver for the cyclical downturn. So I think that's going to drive a sustainable multiple expansion for these companies.
Well, you just taught us more in 5 minutes than, you could search the internet for hours and not get all that. So great job explaining that. And it makes a lot of sense. So thanks for breaking that down for us. Next thing I want to do is I want to look at some of the holdings in the SPRX ETF and talk through those with you, if that sounds good to you.
Sounds great.
So this is the website for Spear, and currently there's the Spear Alpha ETF. It's SPRX is the ticker. And in the intro, we talked about, you're looking at these secular themes. We call them secular growth trends, mega trends, right? So you got artificial intelligence and robotics and all those different things that we love talking about on Fired Up Wealth. You go to the website, it has all the holdings. So you can go here, see the top 10 holdings. You can also click here and download the full holdings. I actually have this, which I think is a little bit cleaner that you shared with me, Ivana. And I just kind of walk through some of these. I have a couple questions that I think our audience does as well. So first things first, Nvidia is 10.67%. I'm going to stop sharing my screen and ask you. So DeepSeek, give us your take. I already know what your take is, but tell us your thoughts. DeepSeek comes out, hey, we created this model for $5.5 million. And the whole thesis for Nvidia and data center is just kapoof overnight. Let's sell our stocks. Tell us what your thoughts, someone that has a lot of expertise, spent a lot of time researching these companies. What's going on?
I think there was a super interesting reaction by the market, right, where people freaked out. And that kind of tells you how much people know about the fundamentals versus just investing from high-level exposure to the AI theme. So I think for most people that are in the weeds, this was actually a positive announcement. So every time you have a technological advancement in an area, it's positive for the value chain. There is always maybe 1 or 2 companies that are directly competing that it could be negative for. But every time you bring, for the most part, a lower price technology to the market, there will be a lot broader opportunity set of applications, and that's just going to drive broader adoption. So it's very difficult to argue that this means less demand for AI, and it's very easy to argue that it will likely mean more demand.
Yeah.
On the price tag, the $6 million, I think a lot of analysts are unpacking and analyzing, well, was it really true? Did they really have illegal exports of or imports from the H100? I think a lot of those factors go in. I think it's very important for people to know that it's very expensive to come up with the first model and come up with an innovation to market, right? It's very easy once you have the innovation to then go and back into it. And I think that's really key here. Whether it's 6 million, 12 million, 100 million, it's really irrelevant. I think the key to understand is that from here, if we want to innovate, we will need more NVIDIA chips rather than less, right? Because you're not going to be able to build anything new and more powerful without the hardware that NVIDIA offers. So I don't think it's negative at all. I think also it's important for people to understand that while we've made tremendous progress here from each generation of models, we're still very far from where we're ultimately trying to go. Right. So a little bit about these models. They're called thinking models, but this is really the early version of them when they're really just like thinking a little bit. They're not continuously improving. So we're going to see a lot more models and a lot of versions introduced where now they're just thinking a little bit, then they're going to be taking in the information and feeding it back to the model. So I think there is going to be a tremendous amount of innovation that happens here on the model training side, and it will require significantly more compute than what we're used to or the models of yesterday required. Now, you're going to be able to do a lot more with less. That's no question, right? That's the whole thesis of technology. And if you look at one of the old podcasts from Jensen, he thinks that that compute needs to decrease in price by 1 million times or something ridiculous like that, right? So this is really the goal here, is to get compute to be cheap so everybody can use it. And we talked a little bit about the applications earlier, where these applications are priced per user. So they're basically priced like, let's say, $30, $40, $50 per user. And then you can use them unlimited. So you really need to have cheap compute for this to make sense for the companies that offer them, right? Otherwise, the business model makes no sense. So I think you're just going to need to have significantly lower compute costs, but that doesn't mean less demand for NVIDIA. It actually means more demand.
Yeah. And I think a lot of people misunderstand the intent of LLMs and chatbots. Like, this is just the start of it, right? So if I'm talking about Stargate, I'm talking about $500 billion, in infrastructure and data centers. That's not just for what we know ChatGPT today is. We're going towards agentic AI, AGI. This is a whole different thing that we're talking about. A lot more computing power needed, not only for training, but inference is a big thing that we're going to talk more and more about as these AI applications start rolling out and actually become usable, because now, inference costs 90% if you look at the life cycle I think I've seen for an AI application, right? So this is where we can go down a rabbit hole and start talking about, okay, well, how does that work with NVIDIA? We know that they're basically the strongest, they're the king when it comes to the training side, but then what does inference look like? And it's a whole different can of worms. But just from a high level, if I were to say, hey, training is going to come down, which we don't think is necessarily the case, but let's just say we make the argument. We're trying to make a bear case here, right? We're trying to be as neutral as we can. Let's just say that it drops off a cliff, which we don't think it's going to. What is the argument on the other side of that? So like for me, when I think of NVIDIA, it's much more than just hardware. It's a whole ecosystem. And they're building all these NIMs, and you've got, Cosmos and all those different things it's the software ecosystem, this soup to nuts type thing, right? So what does that look like for NVIDIA on the inference side, just from a high level, from your perspective?
Well, I think that's the biggest point that people miss about NVIDIA, where they're thinking of it as a hardware provider. And I think that's a lot of confusion as well on the custom chip side, right? Where people think that, these hyperscalers are going to come up with a chip and then customers will be able to use it right away. So the real moat for NVIDIA is with these frameworks that they offer that are free and that are pre-developed. So if you're a company starting an application from scratch, you're very likely to be benefiting from one of these frameworks, right? If you're like a Databricks and you're really like a tech-first company, sure, you can develop a lot of stuff in-house. But anybody that's developing an application, it is very, very difficult to argue that they won't be able to benefit from this framework. So in my opinion, that's going to be the part that is the hardest to replicate. And even over time, as custom chips gain traction, you're really still going to have a big part of the market that will be willing to use NVIDIA over the custom chips.
So this is a good segue because I'm going to share a slide from you on these custom chips, the ASIC, ASICs. I think this is a good talking point and a good segue into the next big elephant in the room that I want to ask you about. So let me share my screen here. So Ivana, this is something we've talked about in Fired Up Wealth as well. I just shared some slides a couple videos ago. This is the custom chip platform. So when you're talking about custom chips, you'll hear ASICs or ASIC. That's what this is right here. So you've made this slide. It's a really good slide breaking down Broadcom and Marvell technology. Now, one thing that I noticed right away is that Marvell Technology is your second holding in SPRX at 9%, and I don't see Broadcom anywhere at all. So can you share your thoughts on that with us?
So we like the ASIC space in general, and the way we generate alpha usually is we find a space that we think there is going to be a lot of upside and we dive deeper. So what we try to do is identify 1, 2, or 3 companies in that space that will be beneficiaries of that trend. So both Broadcom and Marvell, from a high level perspective, are beneficiaries of this trend, and we see upside for both. Then we go one step deeper and try to understand, well, how much are they going to benefit, right? What platforms exactly they're on? How much does this translate into revenues from these companies? So what I was trying to show on this slide here is the different platforms that each company has won. And you can see that it is actually pretty comparable in terms of absolute size, in terms of which platforms they're on. So Marvell is on the Amazon and the Microsoft platform. And then you have Broadcom on Meta. Meta is really the biggest, one of their biggest customers. And of course, Google. They've been working very well with Google over the past many years. And now Google is bringing their chip. And I think people think that it's going to be one of the more successful ones. So I think those are the 2 key platforms for Broadcom. But if you look at it as total upside, right, or total market size, you will see that because Marvell is a much smaller company, in terms of absolute upside, it's going to be significantly higher if they both execute and deliver. So that's why we like Marvell more than Broadcom. Now, because it's a smaller size, it will carry higher risk, right? So Broadcom will be a lower risk way to get exposure to this theme. But if you are confident that both of them will deliver, the absolute dollar amount should be pretty similar, and therefore in percentage term, higher upside for Marvell.
Perfect. So what you're basically saying is Broadcom's $1 trillion company. Marvell, we're talking about less than 100 billion. So it's a lot easier for this to 10x than, something like Broadcom to go from 1 trillion to 10 trillion. That's what we're talking about.
That's exactly right. Especially since the size of the opportunity is comparable, right? Like if Broadcom had won all the contracts and Marvell had won, it would be a different story. But Amazon is going to be a big deal for the company. And then Microsoft, it's still a little bit TBD and a little earlier because they're going to be a more meaningful driver in 2026. But both of those are very large opportunities compared to Marvell's $100 billion market cap. And for us, it's really key. The way we generate alpha, I always tell people, it's not necessarily catching every company that's going to do well. It's finding the ones that will do well and making sure that we're consistent and we don't have mistakes. So we're always, if we have 2 and we can pick between 2, we would prefer to have 1 in the portfolio rather than be more diversified, because over diversification will make our returns look a lot more similar to a passive index than generating alpha. So that's really what goes into our process. It's all about identifying a specific opportunity rather than providing an exposure to a theme, if that makes sense.
It does. And something we talked about on Friday that I didn't know, and this is actually really interesting. So if someone said to you, well, hey, this ETF looks great, it has a lot of holdings that I like, why don't I just go buy the individual stocks? Now, what we're talking about here with these 2, Broadcom and Marvell, you mentioned something how you can essentially switch like assets and the taxes. Can you walk me through that? Like, how does that work?
Yeah, so there is actually a point about ETFs, and it's not just our ETF. It's a point about all ETFs that I think is underappreciated by the market. Essentially, what an ETF can do is exchange holdings in kind. If, for example, now we own Nvidia, we really like it. If we learn something that makes us believe that Nvidia is no longer well positioned in the value chain, instead of selling it, we would be able to exchange it for something else or for our entire portfolio of holdings. That's usually what we do. We'll just exchange it in kind for a little bit of each of our holdings. So I think that is a very important feature, and it was one of the reasons why I started the ETF, because hedge fund strategies are relatively higher turnover. So to your prior point, like, we do try to find the best play. And this changes from time to time based on what contract they win, right? Based on what fundamentals change in a short period of time. So we do rotate our holdings pretty actively. And this feature of being able to exchange them rather than take a big tax gain is a pretty attractive feature of ETFs. You eventually do have to pay tax when you sell the ETF, right? So I do want to make sure to not like tell people that, hey, like, you don't pay taxes in ETFs. But it's something that I would encourage people to look into further, because I do think there is not a lot of knowledge about this in the world out there.
Okay, perfect. I think it's good just for the audience to hear that. I mean, so I own this ETF, SPRX, and these are the holdings. Everything is in it. You know, if you look at my individual, I've got a taxable brokerage that's $2.6 million. You know, Nvidia is my top holding. It's probably 12% weight, but, you know, very similar. I generally like to keep a lot of my holdings 5% or less. And it is a little bit different because I'm not going for all alpha. I own things like Costco, and I've got, you know, AVGO and a lot of stocks that don't necessarily fit this. But I do own this ETF in the community portfolio. And the way we look at it is we can have a percentage of a portfolio. So we're always teaching people to have a core of ETFs and then build individual stocks around it. So, I mean, you can leverage something like an ETF, like SPRX, to put in a percentage, you know, whatever that percentage is you're comfortable with, your risk tolerance. But it's a way to get exposure to these stocks with maybe you don't have a huge risk tolerance, and you don't necessarily want to buy IONQ or Snowflake as individual stock. Well, you can get exposure through ETFs like this. So I think it's great. And, you know, the reason I bring it up is Ivana started this ETF, and I noticed it right away. A lot of the holdings were very similar to the stocks that we like to talk about and invest in Fired Up Wealth. And I reached out to her, I think about a year ago, and said, hey, you know, this is something we can work on together. I'm trying to build this new studio, and we can, you know, do some collaborations together, and you can help basically fund the studio. So Spear Alpha ETF, SPRX, essentially helped build this studio that I'm in now, part of the funding of it. And so it is sponsored, but it's important for you guys to understand that I would never, you know, sponsor or work with anybody unless I would buy it myself. So I get emails every day about, will you pump this and talk about this? And I don't do any of that. But I really like Ivana. I like her investing methodology and how she goes about things. And it's something that, you know, again, I own it myself, and I think it's a great ETF for you to explore for your own needs as well. You know,
Thanks for the kind words, Eric. But yeah, I think it's very important for people to do their own diligence. And really the key for people to do is understand what their risk tolerance is for products like this, and even more for individual stocks, right? So that's really what it comes down to. How much do you want to allocate to something low risk and passive, and how much can you allocate to something that you expect to be generating a return? So I think it's really a personal thing, and it's important for people to do their diligence.
Yeah, absolutely. Do your own homework, make your own decisions. But, you know, this is really interesting because the majority of these stocks I own now, we talked about the energy plays already. The big ones here being Vistra and Constellation Energy. So that's VST and CEG. That looks like it's about roughly 12% of the SPRX ETF right now. Snowflake's my second holding. I think there's lots of great things coming for Snowflake. I really do. You know, Arista Networks is one that I don't own, but, you know, most of these, we go through it. A couple that stick out here. We talked about the energy plays, and there's a few of them on here. Rockwell Automation is interesting because more John Dredd in the community, I know he owns the stock, and he's owned it for a couple of years and made some good money. You know, Credo is one where I talked about it before, recommended it, but said, you know, there's a few things for me. I just don't invest in companies that are, you know, located in Cayman Islands, things like that. It doesn't really matter. The ones that I want to talk about, Ivana, though, that really stick out, and these are ones that I don't own, and I think that they're very expensive at these levels. So IONQ here and Rigetti Computing. So quantum. There's no doubt that quantum is big, is going to be big someday. What's your take on quantum though? How long are we talking here? What's the investment thesis? I'd love to hear any thoughts about these quantum names.
Yeah, for sure, Eric. So I spent a lot of times on a few separate occasions diving deep into the quantum thesis. And I was also very skeptical on it about a year ago. What we started noticing in November and December of last year is several announcements where companies are taking accelerated computing like the CUDA-Q platform, and are using that to reduce errors. And that's a pretty big change that's happening in the quantum space. So that's what we usually look for. We follow these spaces on an ongoing basis, and we're looking for when the change will happen. So you'll hear some people say, oh, it's 15 years out or it's 10 years out. That's really not so important. What's important is there any change happening today, and what does that mean for this stock? So that's the reason why we decided to dig one level deeper and understand exactly how important is this, what will it mean. So what we think is going to be happening over the next year is that so far for quantum computing, it's really been limited to only research type applications. So you're going to see this, whether it's like defense or labs or other research institutions, it's really been those companies that are spending money. What we want to see if we can get some more intel this year is if quantum will get into the more commercial applications, not necessarily looking for broad wins or like big applications, just seeing companies to start experimenting with quantum computing on the company side. And we have a lot of relationships with companies in the industrial space. So that's what we're really digging deeper here to try to understand when will this interest start coming through, and when will we see both Rigetti and the IONQ are available on the AWS platform. Is just a very small percentage right now of what they do in terms of commercial customers. That's what we're looking for. When are we going to see these commercial customers ramp? And from valuation perspective, we use a very different framework for these highly speculative companies, and Tesla falls in the same framework as well. This is basically companies that generate close to nothing of revenues. Even though Tesla has a lot of revenues, they don't generate a lot of revenues from robotaxis itself, right? They generate nothing. There's not even a robotaxi that drives by itself today. So we use a very different framework that it's much more similar to valuing options rather than to valuing companies, right? So it's really all about what do you think will be the option value of this opportunity today if it were to achieve a certain size. And I'll give NVIDIA here as an example because we've been following it for a very long time. And I think a lot of people think that NVIDIA appeared in 2023 when ChatGPT got announced, but they had been working on this AI opportunity for 15 years now. And really the beginning was just what quantum computing is doing today, just proving out use cases, talking to companies, trying to figure out if there is a market, right? So, and this just takes time to build and also a lot of volatility. So NVIDIA wasn't going up in a straight line. There were ups and downs. So I think that's very important kind of as thing for people to understand as a template that while it's good to have exposure to these more volatile companies, it's very important to manage the risk in them as well.
So when you think of, the really big social media retail investors that are, a lot of people say quantum bros, right? And say like the quantum bros think that Nvidia is just going to get displaced and disrupted. It sounds like you don't believe that because Nvidia is your top holding, but yet you still have a couple of these quantum names. So what are your thoughts there on some of those people that think that you have to pick one or the other?
Yeah, I think that's very interesting actually that people are so bifurcated on the two because it's really NVIDIA's technology that is helping the quantum computing companies improve, right? So, and it's clearly not going to be the case of one versus the other. They're very different applications that each technology works well in. Quantum computing is particularly well suited for optimization type applications. It's not necessarily as well suited for parallel computing application. So I don't think this is like a case for it presents an immediate risk to, or even a medium-term risk to Nvidia, as I think you're still going to need accelerated computing even to advance the quantum computing side.
Yeah, makes sense. I agree with that. I think one of the big hangups for a lot of people is if they didn't get in those stocks really early, they're pretty expensive, 200, 300 price of sales. But it sounds like, with that said, the reason those numbers are so high is a lot of them don't really have any revenue at all. The revenue is so small. And so the idea behind that, I guess, would be that a couple big customers can make that revenue jump when now that multiple shrinks. Am I on the right path?
That's spot on, right? Okay. So if you look at revenues like 5 years out, if you have confidence that they will get those 5 or 6 customers, that's really how we get comfort around these investments. And then the other thing that's very important is when you size them, you don't want to be sizing them. You want to be minimizing your loss, or like you set a maximum position that you know that this could go out of business, right? So it's not necessarily if they don't get the customers and if the technology doesn't get commercialized, you don't want your whole fund to be dependent on that. So that's a lot of what goes on in our internal risk management is basically position sizing. I think that's one thing that I want to kind of highlight as key for people in terms of what hedge funds do differently than the traditional mutual fund investors or retail investors. For hedge funds, it's all about risk management and risk reward. So key will be sizing your positions and managing the downside as well as capturing the upside.
Yeah, that makes sense. Yeah, that's really good. Really good thoughts on all that. And the thing is you and I could talk. I mean, we talked Friday for 2 hours, just kind of like preparing and not even really preparing, just kind of shooting the breeze, So really good stuff. And when you're talking about those quantum names, what we call them is a spec stock. So like something that's more speculative, right? And you think of the life cycle of a company, you go from spec to hyper growth to growth, mature growth, and you got the dividend part of it. But like these spec stocks can be a 10x or 0. They can literally give you 1,000% return, or like to your point, they could go bankrupt. And so it's important for people to understand that. And for people that try to invest, individual stocks, you don't necessarily want to go buy, 5 spec stocks and call it a portfolio, because it's very high risk reward. And generally speaking, those don't work out very well. I mean, when you're investing in spec, you're not going to be right every time. And that's kind of what you're alluding to, I think, by positioning sizing. Like, no matter who you are, Peter Lynch said, if you're right 6 out of 10 times, it's a favorable result. Warren Buffett's made mistakes. I mean, any investor that we talk about has made mistakes, right? So we're going to make mistakes, whether we're, Fired Up Wealth, whether we're Spear ETF, whether we're an individual investor, a hedge fund. Nobody's going to be perfect all the time. And it's a lot harder than it sounds to be right every time. A lot of people come into the market, they're new, they'll think like, well, these people have all this expertise and money. They should just be right every time. It's not quite as easy as that, right? It's a little bit harder. We've been doing this for a long time, and I've been investing for a long time. I'm obviously not on the institutional side like you are, but I've been an individual investor since the late 1990s. I've seen a lot in my time, right? A lot of crazy ups and downs and cycles. And if you think about just the S&P 500, even our companies, the fail rate is pretty high, right? I mean, so the more speculative it is that, is it the verge of bankruptcy if it doesn't get that next win, the higher risk it's going to be, right? You can look at some of the stats. I was trying to pull this up in our Discord, but some of the stats for failure rates. So if you look at this, you see your screen. This is the survival rate of U.S. businesses, and it goes from agriculture down to mining, oil and gas, 25%. Technology, 29%. So if you look at this from 2013, this is the survival rate of U.S. businesses. So, I mean, the point here is that you're not going to be right every single time. Not every business that's created is going to be the next Microsoft or Amazon or Apple, the next FANG stock. It's a lot harder than that. But it is important to understand if you get into these small companies when they're $1 billion, $5 billion companies, and they don't have to be $1 trillion companies to make a lot of money, right? A $1 billion company go to 10 billion, you make a 10x, so that's kind of the thought process, I think, around, those quantum names. And feel free to jump in and tell me where I'm wrong, but I'd love to.
I think you're spot on, Eric. And really, it's very important for people to understand that the way to generate wealth over time is by compounding. So while we always get attention when we have great numbers, and that's great, we like to have great numbers, really the key to our performance is how we manage risk on the pullbacks. It doesn't have to be like a recession. Even a minor 15-20% pullback, it's very important for us to manage risk well. And what we do is we have very clear thesis on companies. And if the thesis is changing, we get out. So it's a pretty active process of managing risk. And really the key here is to get that compounding effect and not to lose too much money. We will lose money, right? We hold a very concentrated portfolio of relatively high risk investments in a technology space that's also relatively high risk than everything else. So there is quite a bit of risk into the portfolio, but it's really key of how you manage through downturns, because if you lose 80, 90% of your portfolio, it's going to be really tough to dig back out of that hole. So the key is really to find the right level of risk and compound your returns rather than go up and down based on like what an individual company has done.
Absolutely. Yeah, it's better to make a little bit of money than, to your point, lose 80%, because we share those numbers all the time. Like if you're down 80% on a stock, you basically have to have a 10x to break even if you're down 90%. Well, yeah,
they're not always as exciting to viewers, right? They're like, oh, why don't you tell me how to get rich? But I think that's really the way to get rich. You minimize how much you lose on downturns and recessions, right? And you kind of position yourself as stronger for catching the next leg up.
Yeah, absolutely. And there's the two phases, accumulation and preservation, right? Like Spear Alpha, you're focused on accumulation. So young investors that are trying to capture these disruptive technologies and want to do it through an ETF, it's a great way to do it. Not everybody can buy ETFs that's watching, but we're talking about the individual stocks too. And Ivana's nice enough to come here and share her thoughts and give perspectives that maybe fill in some gaps, for certain areas like energy that I haven't spent as much time on and things like that. So it's been really good talking through that and just talking through all this with you. And you've brought a lot of great insight to the community. So I do thank you very much for your time today. One last question. I want to make it interesting. I'm going to catch you off guard maybe a little bit and put you on the spot. I ask a question, this recent pullback, what are the most interesting areas? So say I'm a new investor and I'm trying to figure out what areas I should be investing in. We just had a nice pullback here. What areas would you be looking at? What would you tell them?
So I'd say, Eric, the power generation side definitely screens as one of the most interesting ones because it got hit the hardest. That's where the weak hands are. And that's where basically carnage happened, even though this company's fundamentals did not change at all. So I would look at power gen, Vistra, Constellation, do your own work, figure out how much risk you want to take. Constellation is lower risk than Vistra. Vistra will be the higher risk one because it has a lower quality portfolio, but both of them have pretty decent risk adjusted return expectation. And then I would also look at the networking side. I think this is one of the areas that is the most interesting going into next year in terms of where performance improvement is going to come from for the chips. So it's really going to be how you're connecting the chips. So networking is very interesting. I think we talked about Broadcom and MRVL. I would look at Astera Labs is one that's been on our radar and we've been doing a lot of work. And Credo is a smaller one. I think Astera we prefer slightly more to it, but they're coming up with very innovative solutions that are very niche and can scale pretty rapidly as data center investments scale. So I would say power gen networking really got obliterated on this pullback. So that's where I would be looking for opportunities.
And something like SMCI, is it something that's just, for me, it's too much risk for me to take just with the not knowing what's going on, auditors? Some people. I
agree with that. I think if you're involved in SMCI, you need to be a professional investor that has dug through the filings for whatever is available and has hired lawyers. So that's how we would usually do it. If we were to do work on this, we would actually hire lawyers to look through the filings and risks. And I think it's a little bit too much work for the return. I think there is good opportunities out there where you don't have to do that extra level of litigation risk. So I think that's probably how I would feel as well.
That's perfect. I look at it as like a gamble. I mean, because you don't really know.
Exactly. If you're not going to do the work, it's a total gamble. If you're just going to buy it because of a hope that it goes up, it may play out, but it also may not. So I think if you're willing to take it to the next level and do the work, there may be an opportunity there. But I think for a retail investor, there is better risk reward opportunities out there.
And the margin profile is low, and we could go on and on. But this has been absolutely wonderful, and I'd love to do it again sometime soon, Ivana. I can't thank you enough. I'm sure viewers are going to be ecstatic to listen to your thoughts on all these different exciting areas. Thank you very much for your time. Have a great rest of the day. I appreciate it.
Thanks for having me. Great seeing you.
See ya.